All right, folks, today is Wednesday, March 15, 2023, and it's time to see how I invest $1 million. Uh, I am fighting a cold, so if my voice sounds a little bit froggy or whatever, I apologize in advance, but let's get right to it. All right, so let's go ahead and go to Schwab and log in. I have my Symantec hardware token for the two-factor authentication, so let me get a code and we will log in. If you haven't seen my video on two-factor authentication, you really should go and take a look at that. Just because, when you have a lot of money on the line in your banks, brokerage, whatever, using no two-factor authentication is definitely not recommended. But even when you're using something where you're getting a code from text messages, SMS is not reliable. It's not very secure. So you do want to utilize a two-factor authentication method that is more secure. And I think the best is a hardware token. So if you want to learn more about that, look at the link below. But let's get right into this $1 million portfolio. So when I first made this account, it's not really my portfolio because my portfolio is a lot different. But when I made this account public, I started with just above $1 million, maybe 1,020 grand or something like that, and it went up to maybe 1,040 at one point. I'm not quite sure. I gotta check the tail of the tape to see what it looks like. But since that time, this was late 21, I believe. 2022 was a rough year, and the markets was one of those once in a generation or once every 40-year type, of performance, especially with the long bonds. Because when I share this allocation, a lot of people always ask me, why have long bonds? Why have gold? And what you're seeing today is actually what is supposed to happen, but it did not happen in 2022. So right now, the $1 million portfolio is sitting at $908,000. So we're down maybe 9.2% from a million, but moving in the right direction. Today, the portfolio itself is up 3/4 of a point, so about $6,700. When you look at what the S&P 500 is doing, down 1.66, and what the Nasdaq is doing, down 1.05, you see that this allocation is doing its job, right? Gold is rallying, so are long-term treasuries. And that's really the reason to have these asset types in the portfolio, because they usually, not always, as we saw in 2022, but they usually will be uncorrelated and move in different directions. And that's exactly what you want. When one of your assets is zigging, you want the other one to zag. So this is where we sit for this month. No buys because there's no cash. I mean, I think I have 37 cents in cash. The only thing that I'm really doing is that I am selling options. Excuse me. And you see that I have these weekly options on gold and weekly options on the long-term treasuries. I will sell an options contract on my NASDAQ maybe in 30 minutes or so. But the NASDAQ, I'm selling daily options. And what I'm doing is trying to price it very conservatively so that it doesn't get called away from me, but generate enough extra cash that I can just slowly add to these positions. So right now the allocation for the portfolio is pretty much spot on where it's supposed to be, as you can see on screen. So we're good to go. About the only other thing that I want to kind of talk about as it relates to why you're seeing such this huge increase in long-term treasury is what happened this past week with the collapse of three regional banks, starting with Silicon Valley Bank, Silvergate Capital, and then over the weekend, Signature Bank of New York. That is certainly causing a flight to safety. And although I like the result that it's causing long-term treasuries to go up crazy because people are flying to safety, I don't think it's going to last, right? This is another one of those classic overreaction. People are looking at what happened with these regional banks that took on a lot of risks because, especially with Silicon Valley Bank, they had 205 billion in deposit or something like that. They were the second largest bank failure in history since the Washington Mutual collapse during the Great Recession. But what they did with all of their deposits that were highly concentrated in a handful of clients that was getting easy money from their venture capital funds was that they went and bought long-term treasuries, 10-year treasuries that they were trying to hold to maturity because they're reaching for yields. These clients of theirs would deposit large cash deposits, but because they had funding from the VC, they weren't taking out loans from the bank. Traditionally, a banking business is you take in deposits and you lend out the money, and that's where you make your income, but not so with SVB. Apologies, my Frenchie is trying to clear his nose, so you may hear that in the background. But, they didn't do that with SVB. This is a bank that's been around for over 4 decades, and they just had this very concentrated client base and did not practice really let's start again. That didn't happen with SVB because this is a bank that's been in existence for some 4+ decades, and with their client base, they were taking some undue risk. I think they didn't even have a risk officer for the last year or so. They just had one pretty recently, so it's a unique problem is the point that I'm trying to make. But what the market is doing and what you're seeing is that yes, it's understandable that there should be a flight to safety, right? That people get rid of some of their riskier assets and go to government bonds. But the reason you're seeing this huge increase is that there are now talks that next week at the Fed meeting, they won't raise rates. And I think people are being ridiculously stupid in that regard. I think that what the Fed has signaled is that they're going to do everything in their power to fight inflation. And I take them at their word for it, and I know that they're serious about it. The problem with folks like SVB is that even though they heard the message, they went ahead and bought these 10-year bonds. What did they expect was going to happen when rates went up, right? You have some of these same people now saying, oh, because of this bank crisis, the Fed will be forced to halt their rate increases. I think that's wishful thinking. I don't think that's going to be the case at all. I do think that the Fed has a plan with inflation still between 5 and 6%. They're going to carry it out. I don't think that the failures that we saw with these 3 banks is going to risk, contaging the rest of the banking industry. But, certainly the Fed will look at that because it is the rising rates that cause the values of SVB 10-year bond holdings to go down. And when they were forced to sell it because people were taking out money, they lost a ton of money on those investments. This is not new. But just because, SVB experienced a failure doesn't necessarily mean that this is now going to cause the Fed to pivot. But that's what you hear. I have CNBC on in the background, and everybody is talking about, well, now it's 50-50, they're going to raise rates. Well, I don't think that's the case. Do I know for sure? I don't. Excuse me. Let's be sure. I don't know for sure, but I highly, highly doubt that they're going to change their course of action. We'll find out next week. But again, I'm happy with the performance I'm seeing in the account today. But I think it's wishful thinking, right? We're going to see what happens next week when they announce a rate increase, probably 25 basis point. We'll see what happens. But all those folks that are hoping for 0, yeah, I don't think so. But, we'll see. If it does happen that, there's always a chance, right? You can never say never. If they do not increase rates at all at the next meeting and just kept it at its current level, so 0 increase, my prediction is hang on for the ride because the market's going to overreact on the upside, right? But if you have a plan, if you have an allocation that works like I do, just keep on investing. Hold on for the ride. It's all noise, right? That's it for this $1 million portfolio update. I'll see you on the next one. Later. Bye.